we go. All right, so today we're continuing to look at the choice of insurance policy by consumers. And then we'll get kind of a prelude to the ACA and the things involved there with insurance choice. And then we'll look at this question of self-selection and stability, and that really has to do with insurance companies being able to find ways to identify people that are tend to be sicker and people that tend to be healthier in order to try to spend less money, basically, be more profitable. So that's what we're looking at today. But before we do that, I want to just do a quick refresher of where we left off. So last time we were looking at the welfare loss from insurance, right? And this is the demand for two different diseases and the associated welfare losses. So remember, right, we were talking about two possible diseases, one's worse than the other, and they have different probabilities of occurring, right? And so we were able to sort of derive or calculate an expected benefit from having insurance, right? So we were given a risk premium and added some things together to calculate basically the net benefit of the insurance policy, right? Which in this numerical example was $980. Okay, so that's where we left off. Okay. Let's see where, I think this was the last slide. Yes, this was the last slide. All right. Excuse me. So the expected loss associated with the moral hazard, which was $80 in this example, depends directly on the elasticity of the demand curve for medical care. So that's important, right? So we could think about a very inelastic demand curve, very close to being vertical, which would, of course, cause a very little change in demand due to insurance, and the expected welfare loss would be very small or much smaller. Conversely, of course, if demand was very elastic or closer to being flat, the welfare loss would be much larger. So in other words, the more elastic that the demand curve is, the flatter that it is, the less desirable it is to insure against that disease or against that risk with the more kind of standard types of insurance, right? So in a picture, this is what we're talking about, right? So D1 is relatively elastic, D2 is relatively inelastic, and you can see the corresponding welfare losses, right? So those welfare losses get bigger as the curve gets more elastic. So we talked about optimal, or I mentioned optimal insurance as something we would talk about today, although we're not going to get to that till Wednesday. But an optimal level of insurance, or co-insurance, I guess, trades off these two types of welfare losses in a specific way. So we have the moral hazard loss and we have the risk premium loss, right? The loss that a risk-averse person has because they face a risk. So we can actually relate those losses to the optimal co-insurance rate, C star. So it's simply the fraction or the percent of total welfare loss that's the result of the moral hazard portion. Right, and so the moral hazard loss increases and the risk premium decreases as the co-insurance rate falls. So the optimum at C star, excuse me, I've got something in my throat. So the optimum at C star is basically matching, right? Like I said, the fraction of moral hazard losses as a total fraction of total welfare losses. I need to get a glass of water. All right, so this is not a very straightforward model. It's a little bit complicated, but it does provide us with some clear predictions. The first is that the demand for insurance should be higher when there's more financial risk, right, that the consumer faces. So this is basically you're thinking about the cost, right? What is it going to cost the patient, right? And also, what is the probability of having that illness or disease that causes that expenditure, right? So those two things in conjunction is the financial risk. Another clear prediction is that the demand for insurance should be lower the more price elastic the demand is. Right? So those are the two crystal clear predictions of this model. Demand goes up when there's more financial risk, and demand goes down when and remember, we do have to be careful, right? Because we're kind of simultaneously talking about the demand for insurance and the demand for medical care. So be sure that you're understanding the distinctions where they are, right? So the demand for insurance is lower when the elasticity of demand for medical care is more elastic, right? When demand for medical care is more elastic. So, all right. So these are some good predictions, right? What does the evidence say? What does the empirical evidence say? Well, one simple way to test this is just to look at the portion of the population that has health insurance against specific risks, right? Such as hospital care, surgical procedures, dental care, and so on. So, of course, surgical procedures tend to have a higher degree of risk than dental care, right? And so there should be different financial risks in those instances. And also the elasticity of demand for those types of care is much different, right? Surgical care is very inelastic. Your doctor tells you, hey, you need surgery. You need it, right? You're going to be really, really inelastic compared to dental care, where it's like, you can go without it if you don't have the money, right? So not only are the financial risks different, but the elasticity is different, and oftentimes they're actually correlated, right? So really high risk, financial risk things like surgery are also going to have inelastic demand, right? So they're often correlated. But in any case, we see these patterns that the model predicts, right? Let me get my laser pointer here. Okay, so we have high financial risk, also really low elasticity, and a large number of people are insured. And as we see the risk decline, as well as the elasticity increase, those things go down. The number of people insured goes down. So it seems like the evidence, this very simple way of looking at it, is backing that up. Now it's nice here, this surgical and in-hospital medical care has the same elasticity to demand, but is a little less risky, which is nice because we can kind of look at these two as a way to ignore the elasticity aspect, right? Since the risk and the elasticity move kind of together, since it's the same here, we can look at the differences in risk and attribute that alone to the change or the difference in insurance coverage, right? So again, we see a decrease in risk, a decrease in financial risk seems to reduce the demand for insurance. And that's, ceteris paribus, holding elasticity constant, right? So that's nice. Now, we do have to be careful when talking about the price of insurance. We have to define the price appropriately. It's not simply the premium paid, right? Because the premium includes essentially the average expense of something that the consumer would have to pay anyway, right? It's an expected expense, an expected medical expense that they would pay whether they had insurance or not, right? So, um, really, the right way to think about price is that it's the markup above those expected expenditures or expected benefits, right? The markup that the insurance company adds above and beyond those expected expenses, right? So we can calculate the expected benefits, right? We've already seen this before. It's the percent that's covered by the insurance company, 1 minus C, times the expenditure, right? The premium that's actually paid, right? The amount that's actually paid can be defined as um, the total expenditure, right? So this is the expected benefit that the insurance company expects to pay out, and they're adding a loading fee to it, right? So we've talked about this loading fee, so that's what L is, right? So they're adding on this loading fee. They're charging some percentage above their expected payout, right? Of course, if L is 0, then essentially the insurance is free, in the sense that there's no charge for bearing risk or the administration of the insurance plan. So really, L, the loading fee, is really the price, or the loading fee times the expected benefit, I guess. Now, just with any other type of good, right? The demand for health insurance behaves in a similar way to changes in this price, right? As the price increases, the quantity demanded goes down, right? So if the loading fee is higher, the consumer will select a higher co-insurance rate. They will, in other words, they'll choose a lower amount of coverage, and the portion paid by the insurance company will be smaller. The same idea holds if the policy has a deductible in it, right? We've talked about deductibles. Um, Basically, higher loading fees in that case cause the consumer to choose higher deductibles. And of course, in the free market or the market for insurance, the price is being determined by supply and demand, right? So of course, we're learning demand right now, and we'll look at supply. Hopefully, start looking at supply on Wednesday, if not next Monday. But um, so one interesting thing that we haven't considered yet is the possibility of preventive care, right? So let's add prevention to the picture, right? So these, what are some different types of preventive care? Things like flu shots, regular checkups, physicals, um, blood tests, right? Those types of things. Things that are not reactive to a disease or ailment, but are actions that are trying to prevent illness, right? Um, and so, preventive care is different in a lot of ways than other types of medical care, in the idea that it's very predictive, right? It's just as predictive as going grocery shopping. Um, I can tell you pretty much what I buy at the grocery store every week. I buy a gallon of oat milk, a dozen eggs, right? Like it's pretty much the same stuff every week, with very small changes here and there. And preventive care is like that in the same way, right? People go and get their flu shot every year, when winter comes around, and they go for regular checkups and all those sorts of things, right? Women go to the gynecologist at least once a year, typically. So, right, these are all very predictive, which is much different than other types of medical care where it's like, oh, I'm randomly sick and now I need care. Very unpredictable, right? So it seems like maybe it's something that shouldn't be covered by health insurance. If it's predictable, why cover it? There's really no risk, right? If it's predictable. But it seems like there might actually still be some reasons to insure preventive care. Um, and namely, it reduces financial risk, and that's a risk borne primarily by insurance companies as long as the coinsurance rate is below 50%. And at the same time, it helps to reduce these expected welfare losses that we have been talking about, right? Um, so we're going to see how this works in figure 10.6. All right, so to kind of work through this, we're going to think about a consumer or patient that's infected with influenza or is at risk, I guess at risk. So maybe they haven't necessarily contracted, but they're at risk for influenza. Well, no, I guess we are assuming that they are infected. So, um, all right, so A shows this patient's choice of medical care if they did not have insurance, right? Um, and the rectangular area A is the expense. So they choose M1 as their amount of medical care. P is the price, and then M1 times price is the total expenditure on the medical care, right? Area A. And what does a flu shot do? Well, it reduces the probability of infection, and therefore it reduces the financial risk, right? Not only does it reduce the financial risk, it also reduces, well, I guess therefore it reduces the expected expenditure, right? So we could calculate the expected expenditure as A times the probability of getting infected, right? So if there's a 50-50 chance, let's say the expenditure is $500, and but that's only if you get infected, right? And there's a 50% chance you get infected, then the expected expenditure is half of $500, right? $250. So the shot, by reducing the probability of getting infected, reduces that financial risk, right? The expenditure, the expenditure doesn't change. It's still $500 if you get infected, but it's less likely that you get infected with the shot. And we could even go to the extreme and assume the vaccine is 100% effective, right? In that case, it entirely eliminates any financial risk whatsoever. Right? So it's really, we can think about the vaccine as eliminating two costs, right? It's eliminating the expected cost of treatment. So if it's 100% effective, that cost goes away entirely. But it also eliminates the risk, which risk averse people don't like. They are willing to pay to eliminate the risk, right? So it eliminates this cost of of facing the risk. But of course, to kind of think about this a little bit more, if someone's risk neutral, this is zero, right? Um, so the person's risk neutral, it's only one cost. But if we're assuming that people are risk averse, then there's these two costs that are eliminated because of the vaccine. And we can actually calculate the expected value of the vaccine by adding these things together, right? So that $500 is gone, and whatever cost of the risk is eliminated as well. So both of those things would be the expected value to the consumer. Hold on one second. I got to plug in my computer. It's about to die. All right, thank you. Okay, so now we're going to think about the same scenario, but when the patient has insurance with co-insurance rate C. So in this case, right, of course, the insurance causes the consumer to demand more medical care, right? So the medical care goes from M1 to M2. And then, of course, the total expenditure on medical care is the sum of all of those numbered shapes, right? A, B, C, D, and E. That's the total medical care expenditure. But the consumer only has to pay A plus B, right? And so the patient's financial risk is reduced because their total expenditure is now the book doesn't say this, but technically this is only true if demand is sufficiently inelastic. Okay, if demand is very elastic, this isn't necessarily true. But as long as it's sufficiently inelastic, their financial risk is reduced because their expenditure is lower, um, and their expected medical expenses reduced as well. So the risk is reduced, and the expected medical expense is reduced as well. So how does this affect the consumer's behavior? That's the question, right? That's the important question. Well, that depends, right? A common answer from economists, it depends. Um, right, it really depends on how the insurance is priced. So this is kind of actually adding yet a further complication to this model. But we really need to think about it from the standpoint of the insurance company, right? They're looking at facing this expense, this potential expense of C, D, and E, right? Now, of course, if the consumer gets the vaccine, and remember, we're assuming that the vaccine is 100% effective. If the patient gets the vaccine, it reduces their expended. It actually eliminates, in that case, their expected expenditure, right? Which, if it's not 100% effective, is going to be positive. But right, the expected expenditure is C, D, and E. The sum of those times the probability of infection. If the vaccine's 100% effective, the probability of infection is 0, right? Anyway, so that's what they should expect, right? To potentially pay out. That's their own financial risk. And if they ignore the patient's behavior, then the sort of internal private incentives, internal to the patient, are going to be diminished, right? And so with insurance, it's looking like patients are really not going to be incentivized to pursue preventive care, right? So there needs to be something to push patients to get preventive care when they have insurance, right? How can the insurance company incentivize getting the flu shot? Well, one thing they can do is that they can cover it in the insurance, right? We've seen that when something's covered in insurance, it increases the demand for it, right? So that's pretty straightforward and easy. Just cover it under the insurance. They could even make it the insurance coverage for preventive care more generous than other types of care, right? Another way is by altering insurance premiums based on the consumer's behavior. So some examples of this are smokers versus non-smokers for life insurance, or your accident history for auto insurance. Okay, this is what is known as experience rating, right? Um, but this is actually almost never done in the health insurance industry. So, and there's reasons for that we're going to talk about. There's another important thing that matters a lot, and that's the nature of the preventive activity. Um, really, uh, depending on its effectiveness, the time effectiveness, how long does it take to be effective, right? So think about flu shots; they're almost immediately effective, whereas quitting smoking has effects that are far in the future. They're not immediate, right? And most preventive measures actually have effects that are far off in the future, which makes them less value not only to consumers, but to insurers as well, which basically reduces the incentives for preventive care on both sides, right? And this is actually the issue that is covered in chapter 16, or this issue is part of the discussion of externalities in chapter 16. So um, really interesting material. I really encourage you to take a look at chapter 14, since we're not going to have time to cover it in our class. There's another way that preventive care might be incentivized, and that has to do with employer-based insurance. Um, and a lot of employer-based insurance plans offer these wellness plans. Um, and it's basically, ways to try to incentivize employees to be healthier, essentially. Um, and this is beneficial to the employer in a lot of ways, right? It reduces their health insurance cost, right? Because they're basically with employer-based health insurance, all of the employees of the company form the insurance pool, and when your entire workforce, your entire employee base is healthier, your pool is healthier, and the cost of your insurance will be lower, right? So it reduces the employer's health insurance costs. And it also improves productivity because your employees are healthier. They're sick fewer days. When they are at work, they're more alert, they're more aware, they can think better, right? So it seems like businesses, right, employer-based insurance seems like maybe the best way to try to incentivize preventive care, right? And a lot of this has to do with the fact that the employer has a much stronger tie to the employee than the insurance company, right? So this seems like maybe a good way to get preventive care out there and working really well is through employer-based insurance. All right, so that's everything having to do with insurance choice. So now we're going to start talking about issues related to the ACA, right? Um, and the ACA deals with these issues through um, two mechanisms primarily. The first is that it requires all individuals have some form of health insurance um, at some minimum cost, at some minimum level of coverage. Um, and then there's also this rule regarding pre-existing conditions. And so basically, insurance companies are forbidden from discriminating based on any sort of pre-existing conditions. So they cannot charge different premiums to those with pre-existing conditions. They also cannot deny coverage to those with pre-existing conditions. Okay, so you can see hopefully how this relates directly to, um, you know, these issues of well, actually, we're kind of heading this way, but hopefully you can see how this will relate to welfare loss and financial risk and all these types of issues, right? But we kind of need to have a little bit better understanding how health insurance markets would work without this rule to see what the impact would be, right? So that's what we're going to do. We're going to look at a world where the ACA doesn't exist yet. So pre 2010, basically. So to think about this, we're going to think about sort of this theoretical question that is still kind of lingering um, about the intrinsic stability of a health insurance market. And the issue is one of asymmetric information between the consumer and the insurance company. So this is different than the asymmetric knowledge between patient and doctor that we've talked about, right? This is between the insurance company and the patient and the asymmetric information that exists between those two people. Uh, Primarily that the consumers, the patients, know much more about their health than the insurance company does, right? That's the information asymmetry that exists. And so really what the problem is that arises from this asymmetry is that um, the insurance company is at risk of attracting high risk or high cost patients through a process known as adverse selection or self-selection. Okay, so basically the idea is that um, I'm a really sick person. I know I'm sick, so I want insurance, right? I want good insurance, but I'm gonna pretend like I'm a healthy person, right? So that I get good prices for that insurance coverage, knowing that I'm very likely going to use that insurance and have a lot of expenditures, right? So adverse selection and moral hazard go hand in hand. Um, right. So if the insurance company does attract sicker patients, sicker customers, then these patients will be part of the insurance pool. And since their costs are higher, it increases the cost of or price of insurance for everybody in that pool, right? The costs for the insurance company go up too, and it may even cause the insurance company to go out of business if the costs are too high. So this is sometimes called bad risks chasing good risks, which happens with insurance and insurance pools, right? If you're sick, you really want to be part of a good insurance pool where there's a bunch of healthy people because the prices are low, they get really great benefits, and you're sick, so you need those benefits, right? But then the more sick people that join that pool, prices start going up, costs start going up, and pretty much, well, we'll see what happens in a second here, actually. So there are some potential solutions, okay? But it does come at a cost to the healthier group. So that's kind of the downside, is that even with the solutions to this problem, right? Without the solution, healthier people are worse off. Sick people join the pool, everybody's cost of insurance goes up. The solutions, unfortunately, still ultimately harm the healthy people, but they're at least made a little bit better off than the other scenario. Um, so basically, the insurance company, what it can do is it can basically create two plans, right? So we're basically going to assume that there's two types of people. There's sick people and healthy people. And so the insurance company in this world can create two plans where healthy people only select the plan that's made for them, and sick people only select the plan that's made for them. And in doing so, they self-select, they self-identify themselves through their choice. But the incentives have to be built right, so that's what we're going to look at. But if the insurance company can find these plans that separate these types of people automatically, then it can actually avoid this problem of adverse selection. So that's the goal, is to eliminate adverse selection. But in order to do this, they actually have to deny the healthier group the chance to buy the insurance that they would prefer most. So that's the nature in which healthier people are hurt. Okay, so let's look at these figures from the book. All right, so the basic problem, we start by looking at basically a budget line. Okay, so we basically have a budget constraint. Now, it's kind of interesting because this one's curved, and the reason for that is kind of complicated. But basically the idea is that as the consumer buys more coverage, right, has a more generous insurance plan, premiums go up quicker. And so because the premiums are going up faster, the purchasing power for X, right, which is other goods and services, consumption goods and services, the purchasing power for X diminishes increasingly. Okay, so, it's not that big of a deal. It just looks like a PPF, right? But it's still the same thing. We can think of it in that terms, right? A person's income can produce X, or it can produce health insurance coverage, some combination of both, and there's diminishing marginal returns or trade-offs, right? And then, of course, the consumer just maximizes their utility, right? So they go to the bundle of consumption that gets them to their highest indifference curve, right? Which is going to be where the indifference curve is tangent to the PPF. So in this case, right, the consumer with this budget constraint, or this PPF here, chooses X1 amount of consumption goods and this amount of coverage, right? So this would correspond with a certain co-insurance rate, right? And of course, the further we move this way, the bigger C is, or I'm sorry, the smaller C is, and the more the insurance company covers. So what if, right, the question then is, what if the insurance company can sort of charge different premiums, right? Well, that's what I just went over about why it's curved. So, but yeah, let's assume that the insurance company can charge the sickly type of person a higher premium. And basically what this does is it shifts in their PPF, right? It reduces their budget constraint. so they can afford fewer things, essentially. Now, it doesn't affect their ability to consume X, right? If they don't buy any insurance, then they can consume as much X as a healthy person, right? So that's okay. So let me mention this real quick. So these budget constraints and indifference curves are for two different types of people, right? These are different people, and the only way that they're different is in their health, right? So there's one person's healthy, the other person's sick, but in every other way they're identical, right? Keep that in mind. And so you might notice here that their indifference curves cross, which typically isn't allowed, but that's because these are different people, right? And so the sickly person has a different set of preferences because they're sicker, and they actually prefer more coverage, which is why their indifference curve is flatter than the healthy person. In any case, I'm sorry, they had that backwards. The healthy person's is flatter than the sick person's because the sicker person has a stronger preference for insurance. All right, so if so, this depends on a very important assumption. That's assuming that the insurance company can identify these people, right? You're sick, you're healthy. I'm charging you this, I'm charging you this, right? In that case, it just shifts the sicker person's PPF in, or their budget constraint in, because they're getting charged higher premiums because they're sick. And so it shifts in, and then they choose the optimal bundle to maximize their utility, right? So same thing. But then, of course, we see that the healthy person is basically effectively richer. They can afford more X and better health insurance coverage because they're getting charged lower premiums, right? So that's what would happen if the insurance company could identify the two types of people. Okay, so I already went over that. But of course, how do they tell them apart, right? You can't just ask them. You can't say, "Hey, are you a sick person or a healthy person?" Because the sick person is going to say, "Oh yeah, I'm a healthy person. Don't worry. Give me that low premium," right? So that's the main issue: is how does the insurance company tell them apart? Well, you can actually prevent the sickly people from buying the coverage that's intended for healthy people by limiting the plans or limiting the coverage for healthy people. So this is how healthy people are hurt by this, right? Their plans get limited so that the insurance company can identify the two types of people. Okay, so we can look at this in figure 10.9. So here we have the same curves, right, as in 10.8. And here's the sick person's utility curve, their indifference curve. And so basically what the insurance company does is it limits the plan that's intended for healthy people is limited to these levels of co-insurance coverage, right? So in other words, high C, right? So this coverage would correspond with a high in co-insurance rate, so that healthy people are paying a large fraction of their expenses. Now, what does this do? If they limit coverage to this range for healthy people, so this is the plan with a low premium, the sick person cannot make themselves better off by choosing the healthy plan, right? You see that their indifference curve intersects right there at that point. So here's the optimal level with the sick type insurance, and that level of utility crosses the healthy person's budget constraint at point E star. And so by limiting the amount of coverage to healthy people to this range, if a sick person was to choose a coinsurance rate in this range, they would only make themselves worse off. They can only do that by choosing an indifference curve that's lower than the one that's optimal with the sick type insurance, right? Does everybody see that? Does that make sense? They can't get to a higher indifference curve, right? Now, of course, this limits healthy people, right? Healthy people want to choose this level of co-insurance and get to this level of utility, but they can't. That's not available. The most they can get is this level here at E star. So that's what they end up choosing. It's a corner solution. It's what's called a corner solution, because they're kind of forced up against a corner. Basically, they're backed into a corner, um, and so you can see that they're not able to achieve this higher level of utility UH. They have to be satisfied with U prime H, a lower level of utility. So this is something that the insurance company can do to get the types to self-identify themselves, right? Sick people, in this case, will choose the sick plan, and healthy people will choose the healthy plan, but it makes healthy people worse off, right? So that's the cost. Okay, so that's basically what I said in words typed out there. Okay, so this is known as a separating equilibrium because it separates the types, and it's done automatically, right? They do it by self-selecting. There is an alternative solution to this adverse selection problem, and it involves what's called mandatory community rating, which is kind of like experience rating that we talked about, right? That is commonly done with auto insurance and life insurance. You know, they look at your history and whether you're a non-smoker or smoker and all that type of stuff. So it's kind of like that, but it's instead of for an individual, it's for a community, right? So you're looking at the community and you're looking at their experience rating, the community's experience rating, right? Whoops. Okay, so we can kind of look at the same picture and see what that looks like. So that's what we'll see in figure 10.10. So the key here is that with community rating, um, there's a range of insurance plans that are offered, right? In other words, different values of C. But by law, it has to be offered at the same price to everybody in the community. And of course, the community has healthy people and sick people in it, right? It has both types. Now, what we'll see in a second here is that in this world with mandatory community rating, it's actually Pareto superior in the sense that everybody is actually made better off. So it's what's called a Pareto improvement, right? Um, so just real quick, a Pareto improvement is where at least one person is made better off and nobody is made worse off. Okay, that's called a Pareto improvement. Okay, so we're going to go back to our original picture here, but we're going to add a new budget constraint. So this is the budget constraint for the community, right? Because remember, the community as a whole has to be charged the same price. You can't charge a sick price and a healthy price like we just talked about. It's a single price and therefore a single budget constraint. And it lies halfway, or not halfway, but somewhere between the sick person's budget constraint and the healthy person's budget constraint because it's a mix of healthy and sick people. Okay, so in this case, we still have the sick person's utility curve and the healthy person's. We're going to focus on the healthy person. Okay, so here's the healthy person's choice without self-selection. The healthy person's choice when they're limited to that corner solution. And then here's the community outcome. So it's hard to see because this is pretty cluttered, but if we get real close in here, here's the community budget constraint and where it intersects with the healthy person's utility function, their indifference curve. And so as we can see, it's the healthy person would get U double prime H, which is better than the self-selection scenario that we just looked at, right? So healthier people in this case are slightly better off, but they're not as well off as they could be if they got the insurance plan that they wanted, you know, in a non-adverse selection world, right? Now, it's not shown because there would be way too many indifference curves, but the sick person is also made better off, okay? Because they get to enjoy an insurance plan that's closer to a healthy person's insurance plan, although not all the way there, right? So in that sense, it's a Pareto improvement. It improves the healthy person and their utility. It also improves the utility of the sick person. So nobody's made worse off, and at least one person's made better off. So it's a Pareto improvement. Now, the location of this budget constraint, right, is going to depend on the mix of the population. If there's more sick people in the population, it's going to be closer to the sick person's indifference curve. And if there's more healthy people in the population, it's going to be closer to the healthy indifferent healthy budget constraint. Right. So just to go back real quick to the picture, because I think that's a nice way to look at it. Right. So if the population or the community is sicker, this thing gets closer to IS. If the population's healthier, it gets closer to IH, right? But it's going to lie somewhere in between, depending on the mix. Now, of course, if the entire community is fully healthy, it would be equal to IH, and if the full entire community was all sick people, it would be the same as IS. Now, in any case, right, regardless of the mix, sick people are always better off in this community rating scenario than in the self-selection separating equilibrium scenario, right? And in every case, people are made worse off. Healthier people are made worse off than in the separating equilibrium. And the potential benefits to each side of this story is going to depend on that mix in the population. All right, any questions so far? So basically what we're seeing here is that these unobservable differences in people's propensity to become sick is going to lead to a variety of outcomes depending on kind of the approach, right, to the solution. Is it a separating equilibrium approach, kind of in a free market, right, or is it a regulation type approach where these mandatory community ratings are going on? Okay, so what we saw is in a freely competitive market where the insurance company tries to get people to separate themselves, um, it has to restrict the offerings of insurance coverage to the healthy types, reducing healthy people's utility. And the same thing happens in the mandatory community rating, although there is a Pareto improvement, right? But there is, like, you kind of think of it like a surcharge, right? The healthy people have to carry the financial risk of the sick people in the community rating setting, right? So that's kind of the main difference, really, is with the reduction in the utility in the community rating setting comes from the fact that the healthy people are bearing the burden of the sick people, right? In the separating equilibrium, the healthy people don't have to bear that cost. They don't have to bear the cost of the sick people, but they're limited in their insurance choice, so they're made worse off in that sense, right? So it's slightly different ways that they're made worse off, but in both cases they're not as well off as they could be, sort of in a world where they can purchase the insurance they want, right? All right, so this leads us to a conversation of pre-existing conditions, particularly with regard to the ACA, right? Because pre-existing conditions, that's the sick people that we've been talking about, right? Or we could think of it that way, right? These sick people are the ones that have pre-existing conditions, right? So the ACA, the way the ACA handles this pre-existing condition issue is, rather than mandating a community rating, um, it just prohibits entirely insurers from discriminating based on pre-existing conditions. So it cannot do the separating equilibrium type thing, right? Under the ACA, the insurance companies cannot charge different premiums to different types of patients, like in the separating equilibrium type solution, right? That's not a possibility for them. um, So the solution for insurance companies, if they can't do that, is then, okay, well, then we'll do something that's kind of like community rating, although it's not formally mandated, right? And so it has similar effects to the community rating requirements that we just looked at. There's also another benefit to this pre-existing condition portion of the ACA, and that's that it allows insurance markets to also function for risks that are not identified or have not been identified by individuals. So you can think of these as like genetic time bombs, right? Um, Something that's deep in your genes that you're completely unaware of, that um, at some point in your life is going to cause you to be very sick and have a lot of medical expenses. So the pre-existing condition also creates a market for insurance for these types of ailments, right? So that's a nice added benefit. So going back to this issue of stability, right? So the real issue of stability is the fact that if these sick types of patients can disguise themselves as healthy patients, then the insurance company would not be able to be profitable and eventually would go out of business, right? So in that sense, there would not be market stability, right? And so we've been looking at reasons why there might be market stability. One is that in a free market, insurance companies can try to create a separating equilibrium and get people to self-identify, or there may be government regulations that require community rating, where you charge every single person in the pool the same premium, um, and that right leads to this Pareto improvement, which is nice. But there might be some other sources of stability in insurance markets, and one of those is basically transaction costs. And the way that we see this occurring actually is, um, we basically see sort of a community rating solution or type solution emerging without government regulation, right? And in fact, this is coming from employer-based insurance, right? In fact, virtually all employers have a community type rating where they provide the same health insurance coverage to everybody in the company at the same price, right? That's exactly what community type rating insurance plans do. But this is not mandated, right? This isn't a requirement by government. This is just the business choosing to do this um, in a free market, right? Now, one nice thing about this that was a problem for community rating, whoops, is that insurers don't have to worry about this problem of bad risks chasing good risks, or in other words, sick people trying to pretend that they're healthy people for the sake of saving money on premiums, um, right? Because in order to be part of the insurance, you have to work for the company, right? So in that sense, it's difficult for bad risks to attach themselves to this particularly desirable type of insurance plan, because in order to do that, they basically have to be healthy enough to work as well as possess the skills that are desired by the employer. So it's not very easy for bad risks to chase these good risks, right? It's not easy for in this scenario for sick people to try to pretend like they're healthy people, right? They have to get employed by this company. So avoiding self-selection in insurance plans, right? That's the adverse selection or self-selection issue that we've been talking about, um, is an important function of the work group or community work group employer-based arrangement for selling insurance. And something that's really important for this to work is that the work group, the employee-based group, has to use. Everybody has to be on the same insurance plan, and in that sense, the median the preferences of the median worker basically dominate the choice of plan. So this is very similar actually to the to the political science model that we used in the board of trustees, right, for the hospital, right? The median trustee gets their way in the hospital. It's kind of like that here too. And so again, the bad risks can't chase the good risks, and for this reason, um, a minority of employer groups offer a choice of more than one insurance plan. Most employers offer one plan. It's you get it. It's group rated, and we all get to benefit if we're all healthier. So um, so this is nice because it's not government regulation, so we don't have to get the government involved. So it's more or less a free market solution to this issue of self-selection or adverse selection. And you might be asking yourself, well, where's the transaction costs, right? Well, the transaction costs are kind of hidden, I guess. But it has to do with like the bad risks chase. Here's a transaction cost. If the bad risk wants to chase this good risk, they somehow have to get hired by this company. It might be pretty time consuming, right? That might take a lot of effort. So there's one way. But also with the company, right? There's transaction costs involved with the company in terms of providing health insurance plans and that sort of thing. So one last thing we should note here is that this issue of self-selection and market stability might matter a lot more in areas such as long-term care compared to things like traditional hospice care. So why is that? Well, long-term care is typically about the elderly, right? Providing long-term care for people that are retired, that are declining in health, you know, to put it bluntly, just kind of waiting to die. Yeah, I know that's terrible. I'm sorry I said that. But if this is the case, right, the demand for such insurance is mostly coming from retired people, and so this work group mechanism is not available to stabilize the market, right? They're retired; they're not part of a company, so this work-based, group-based type of mechanism for stability is not going to work. Now, how much this matters is kind of an issue that remains to be seen. These markets are in their infancy; they're just starting to form, or at least they were 10 years ago. I'm sure that the latest edition of this textbook probably has some information on this, but I was trying to save you guys a little bit of money. So if you're curious, like you can ask me, and I'll try to do some research for you. But the fact that these markets have been slow to form kind of is addressing this question, right? It's a pretty complicated matter, and so you know, it's going to take some time for these things to really work themselves out. All right. So next time, continuing this chapter on insurance demand, we're going to look at tax subsidies, which is part of the ACA, right? So the Affordable Care Act, part of what it does is that it provides tax subsidies to lower income people so that they can afford insurance. So this is part of the insurance mandate goal. We'll take a look at some evidence, some empirical evidence on the estimates for the demand for insurance. We'll look at the overall effect of the tax subsidy on the healthcare sector. We'll talk about optimal insurance at the end, and also look quickly at a couple other models for insurance. And if we have time, we'll get a preview, start looking at chapter 11, which is the supply of insurance. All right. So yeah, so like I mentioned at the beginning of class, this chapter really needs 3 full days, which I didn't plan for. I only planned 2 days for this chapter, but it really needs 3. So, so like I said, we may end up having to entirely cut the chapter on international comparisons, which I really didn't want to do, but we really have to cover obviously the supply of insurance as well as Medicare and Medicaid, because that's government provided insurance. So we definitely have to cover those. So without a doubt, we'll get through those. And if it means we can't cover the international comparisons chapter, then so be it. But that's kind of where we're at. So, you know, in some ways it's nice for you guys. It's less material to cover, but it's also, it's really an important chapter, which is why I'm hoping we can at least cover it, some of it, with maybe the last day of class. So, but in any case, this is where we are. So on Wednesday, we will finish this chapter and hopefully start chapter 11. And in the meantime, I think, do you guys have a homework due tomorrow? Or is that due Thursday? I think it's due tomorrow. Yeah. So homework due tomorrow. No homework for today. I'll probably assign your next homework on Wednesday, which will make it due the following Thursday. But that's where we're at. So are there any questions about anything? Anybody? All right, cool. Well, you guys enjoy the rest of your day, and I'll see you on Wednesday.
Thank you.
Yep. Bye.